everybody. Today I will discuss net factor income from abroad. Alternate name is Nfia. Then other important concepts like Gdpmp, Gdpfc, Ndpfc, Gnpmp, Gnpfc, Gnpmp, and Npfc. Okay, all the concepts are very important one in case of national income accounting. So first I will discuss Gdpmp. It is the gross market value of all final goods and services produced within the domestic territory of the country during an accounting year. Still remember, within domestic territory, we must consider the contributions of both residents and non-residents. We know that in our domestic territory, foreign MNCs are there, foreign multinational corporations are there, foreign banks are there, foreign institutions are there. Also, their contribution is included in the domestic income. So here it is market price. It is the market price given means it is the market value, and gross, it is the gross market value of all final goods and services produced within the domestic territory of the country during an accounting year. Gdpmp depreciation or consumption of fixed capital is already included. The same thing I have written, being domestic, it implies final goods and services produced within the domestic territory of the country by all producers, both residents and non-residents. Okay, so in domestic income, just to we remember both contribution of residents and non-residents included. Next one, Gdpfc, just simply conversion from MP to FC, market price to factor cost. We know that market price to factor cost, indirect taxes subtracted or subsidies added. Subsidies means financial assistance to the small farmers and small producers. Okay, to increase the production in the economy, to promote the production in the economy. So MP to FC, indirect taxes subtracted and subsidies added, or if NIT given, then NIT subtracted. Okay, NIT, you know that net indirect taxes, it is the difference between indirect taxes and subsidies. You remember MP to FC, either NIT subtracted, or if separately given indirect taxes and subsidies separately given, then indirect taxes subtracted and subsidies added. So Gdpfc, in FC case you consider the money value, MP case it is the market value, but in case of factor cost it is money value. So it is the gross money value of all final goods and services produced within the domestic territory of the country during an accounting year. So Gdpmp and Gdpfc difference is, in case of market price, market value, but in case of factor cost it is money value. Other things remain same. Then next one, Ndpmp, it is from Gdpmp depreciation or fixed capital subtracted. In case of Ndpmp, it is the net market value of all final goods and services produced within the domestic territory of the country during an accounting year. So from Gdpmp, we must subtract depreciation. Then Ndpfc, it is the symbol of the domestic income, net domestic product at factor cost. It is the domestic income. How to read Ndpfc? It is net domestic product at factor cost. It is the domestic income. So it is the net money value of all final goods and services produced within the domestic territory of the country during an accounting year. Next one, Gnpmp, it is gross national product at market price. You remember, national means you consider only the contribution of residents. You include the contribution of residents. The contribution of non-residents is not included in case of national income. Clear? It is gross national product at market price. So we consider the contribution of residents within territory and from abroad. Clear? So Gnpmp, it refers to the gross market value of all final goods and services produced by the normal residents of a country during an accounting year. The same thing I have mentioned, produced by the residents within country and from abroad. In abroad means you know that foreign MNCs, Indian MNCs producing goods across the world. Similarly, it means bank like State Bank of India has branches across the world, and other institutions of India functioning in different parts of the world, and also our people. It means individuals. It means working in foreign territory. For example, you see, suppose American embassy is there in India, and some Indians are working. Okay, so it means American embassy in India. It is the territory of America. It is not the domestic territory of India. If Indians are working, then it means Indians working in foreign territory. Indians working in USA territory. So like this, in case of national, only you consider the contribution of the normal residents within country and from abroad. Then Gnpfc, just here MP2FC. In case of Gnpmp, we consider market value, but in case of Gnpfc, we consider money value. Other things same. It refers to the gross money value of all final goods and services produced by the normal residents of a country during an accounting year. Next one, Npmp. It means from Gnpmp subtract depreciation. So gross to net depreciation subtracted. So in Npmp, it refers to the net market value. Market value here, market price is given. So it refers to the net market value of all final goods and services produced by the normal residents of a country during an accounting year. Then Npfc, it is the national income. Net national product art factor cost. It is the symbol of national income. Net national product art factor cost. So it refers to the net money value. Already I told you, in case of factor cost, we consider money value. So it refers to the net money value of all final goods and services produced by the normal residents of a country during an accounting year. So these concepts you remember. The symbol of Ndpfc, net domestic product art factor cost. It is the symbol of domestic income. And Npfc is the net national product art factor cost. Net national product at factor cost. It is the symbol of national income. Clear? So next one I will discuss net factor income from abroad. It is Nfia. It is the difference between the factor income. Factor income, you know, rent, wages, interest, and profit. 4 factor services are there: land, labor, capital, and entrepreneur. So it means for land, rent is paid; for labor service, wages is paid; for capital, money capital, interest is paid; and for managerial service, for entrepreneur, basically, it is profit. So it is the difference between factor income earned by normal residents from abroad. Abroad means rest of the world. Same thing. It means other foreign countries. Clear? For us, other foreign countries is called rest of the world or abroad. So it is the difference between the factor income earned by normal residents from abroad and similar income paid to non-residents in the domestic territory of the country. So it is the difference. It means factor income received by the residents from abroad. It is the difference between factor income received by the residents from abroad and factor income paid to the non-residents within the domestic territory of the country. Simply, how much factor income normal residents received from abroad and how much factor income we paid to the non-residents working in domestic territory of the country. Here I have written the formula. It is factor income received from abroad minus factor income paid to abroad. The same thing I have written. It is the difference between factor income earned by normal residents from abroad or rest of the world and similar income paid to non-residents in the domestic territory of the country. So how much factor income received by the residents from abroad and how much factor income paid to the non-residents to abroad. So it is the difference. Okay, it is the difference between factor income received by the residents from abroad and how much factor income paid to the non-residents working in within domestic territory of the country. Example, you see some example in case of receipt and payment. Rent. When the foreign bank opened its branch in our domestic territory, we know that it means in our special economic zone areas where port facilities available like Paradip, Visakhapatnam, Chennai, Mumbai, Cochin. So these are special economic zone areas. So basically these areas, it means world class infrastructural facilities is available to attract foreign investment. So basically in special economic zone areas, foreign banks, some foreign banks already they opened their branches. So when the foreign bank opened its branch in our domestic territory on rented basis, then the factor income rent received from abroad. Okay, how much rent they paid to us? It is factor income rent received from abroad. Clear? Similarly, suppose our SBI, State Bank of India, it has branches across the world. So SBI of India opened its branch in rest of the world in abroad. It means in foreign countries on rented basis. Then paid rent. It is factor income paid to abroad. So similarly, in case of wages or salary, already in my previous video, it means already I have discussed compensation of employees. When it means individuals working in different organizations like government or private, it means they receive salary. It means in return of productive services. So just I want to discuss the compensation of employees again. uh, it is the factor income received by the employees from employers for rendering their productive services. So when the individuals working in different organizations and render their productive service, and in return they receive salary. So they receive salary in the form of cash. Kind means quarter facility, educational facility for the children, free medical facility, free fooding facility, and also employers contribution to social security schemes. It is pension on retirement, provident fund, gratuity. So these things given by the employer to the employees. So in case of wages or salary, when Indian residents working in American embassy located in India, American embassy located in India, it is the territory of America. So when Indian residents working in American embassy located in India, it means working in foreign territory, working in USA territory. Then COE received by the employees, it is factor income received from abroad. Clear? So when Indians working in American embassy located in India, American embassy located in India, it is foreign territory for us. Okay, so some Indian residents working in American embassy, so they receive compensation of employees, they receive salary. So it is factor income received from abroad. Similarly, you see, when American residents working in Indian embassy in USA, uh, Indian embassy in USA, it is the territory, domestic territory of India. Okay, Indian embassy in USA, it is the territory of India. When some American people working in Indian embassy in USA, then COE paid to them, compensation of employees paid to them, in salary paid to them. So it is factor income paid to abroad. Similarly, in case of interest, you see, when foreign investors borrowed from Indian banks, then they paid interest. When foreign investors borrowed from Indian banks, then they paid interest. It is factor income received from abroad. When Indian investors borrowed from foreign banks, okay, when Indian investors borrowed from foreign banks, then they paid interest. So it is factor income paid to abroad. So similarly, in case of profit, profit received by the Indian MNCs located in abroad. We know that it means our Indian MNCs, Indian multinational corporations, like Tata Iron and Steel Company, Tisco, Reliance, Aditya Birla, Jindal, Asian Paints, okay, Maruti, Hero. So these are the Indian MNCs, and they are having branches in different parts of the world, across the world. So how much profit they receive in abroad? It is coming to India. So profit received by the Indian MNCs located in abroad is factor income received from abroad. So similarly, foreign MNCs, it means are there in India. Okay, foreign MNCs also producing goods in India. So how much profit they are getting? It goes to their country. So similarly, profit received by the foreign MNCs located in India is factor income paid to abroad. So these are the different examples. So NFI, net factor income from abroad, it is the difference between factor income received from abroad and factor income paid to abroad. Clear? Then different components of NFIA. First component, it is net compensation of employees, COE. Just I told you, it means Indian residents, it means working in abroad, and some foreign residents actually working in our territory. So in case of net compensation of employees, it is the difference between COE earned by the normal residents of India from abroad and COE earned by non-residents in domestic territory of India. Already I have given example when the individuals, when in case of basically individuals, they are working in different offices, different organizations, and render their productive services, and in return they receive salary in the form of cash kind, and also employers contribution to social security schemes like pension and retirement, like this. So in case of net compensation of employees, similarly, it means uh, our normal residents working in foreign territory, so they receive COE. And similarly, some foreign residents, or for us non-residents working in our domestic territory, and it is COE paid to them. So it is the difference between COE received by the Indian residents from abroad and COE, the compensation of employees paid to non-residents working in domestic territory of the country. Second one, net income from property and entrepreneurship. We know that operating surplus, it is income derived from property and entrepreneurship. So it is net income from property and entrepreneurship. Also, it is net operating surplus. It is the second component of net factor income from abroad, NFIA. It is the difference between rent, interest, dividend, and royalty earned by normal residents of India from abroad and similar payments made to non-residents. See, rent, interest already have discussed. In case of dividend, when our residents invest funds on the shares of foreign multinational corporations, again, when our residents invest funds on the shares of foreign multinational corporations, then they receive dividend. Dividend is the part of the profit. Clear? So similarly, it is factor income received from abroad. In case of to abroad, factor income paid to abroad. Similarly, in case of dividend, when foreign residents, when non-residents, foreign residents or non-residents invest funds on the shares of Indian MNCs, on the shares of Indian MNCs, then dividend paid to them. So it is paid to abroad. Similarly, in case of royalty, royalty definition already in my previous video I have discussed. It is payment made to the government for using subsoil assets, for using mining products like bauxite, iron, coal. Clear? So similarly, when those foreign MNCs, basically it means producing goods in India, they made agreement with the government for using natural resources. Suppose one American steel industry, it means producing steel products in India. So this company need coal and iron. So this company made agreement with the government, with the Indian government, and in agreement it is clearly mentioned that it means the company pay 30% of the profit to the government for using iron and coal in India. So it means similarly, it means royalty earned by normal residents of India from abroad, and similarly royalty paid to abroad. Suppose our MNCs, basically suppose Tisco you consider, Tata Iron and Steel Company, producing steel products in USA. So this company also need coal and iron. So made agreement with the USA government, okay, to use coal and iron, and in memorandum of understanding, it means in MOU, it is clearly mentioned that the company, it means Tisco, paid 30% of the profit to USA government in the form of royalty. Clear? Next one, net retained earning. Retained earning, already I told you, it means it is undistributed profit. Profit is divided into three parts. One part is dividend, part of the profit paid to the shareholders. Okay, those people invest funds on the shares of the company. First one, it means paid to the shareholders, part of the profit. Part of the profit paid to the government in the form of tax. Then how much left, it is on distributed profit. Alternate name is corporate saving or retained earning. Clear? So this undistributed profit can be used by the company for future expansion of the business, for future development. Okay. So it is the difference between undistributed profits or corporate savings of resident companies located abroad. So our Indian MNCs producing goods across the different parts of the world. So how much undistributed profit they received, you consider. And similarly, retained earnings of non-resident companies located in India. So foreign multinational corporations also, it means producing goods in India. So they have taken their undistributed profit. So it is the difference between undistributed profit or corporate saving of resident companies located abroad, and similarly same retained earning or undistributed profit or saving of non-resident companies located in India. So three components are there: net compensation of employees, net operating surplus, net income from property and entrepreneurship, and net retained earnings. Clear? Then significance of net factor income from abroad. Actually, NFIA differentiate between domestic income and national income. Okay, domestic income given, NFIA given. So domestic to national, NFIA added with domestic income. Then reverse one, national to domestic, it means NFIA subtracted from national income. So in this case, you see domestic income, it is NFIA is significant to differentiate between domestic income and national income. When we calculate national income, okay, then NFIA, it means added with domestic income. NFIA same thing, factor income from abroad. NFIA is the difference between factor income from abroad and factor income paid to abroad. If separately given, then factor income from abroad added, factor income paid to abroad subtracted. Okay. So when we calculate national income, then domestic income given, factor income from abroad given, factor income paid to abroad given. So when we calculate national income, then domestic income add with factor income from abroad and subtract with factor income to abroad. Just to remember, domestic to national, factor income from abroad added, factor income paid to abroad subtracted. But if NFIA is given, net factor income from abroad it is given, then you should not think about factor income from abroad or factor income paid to abroad, because NFIA is the difference between factor income from abroad and factor income paid to abroad. So if NFIA is given, then directly NFIA is added with domestic income to calculate national income. So just to remember, it means domestic income to national income, then NFIA is added with domestic income. Clear? So same thing I have written. So another one, most important one, national income, difference between national income and domestic income is NFIA. So national income minus domestic income is NFIA. So just reverse one, when we calculate domestic income, national income given, NFIA given. So we calculate domestic income, then NFIA subtracted. Previous case, domestic to national, NFIA added, but national to domestic, NFIA subtracted. Just to remember, when we calculate national income, NFIA added. When we calculate domestic income, NFIA subtracted. Okay, when we calculate national income, NFIA added with domestic income. But when we calculate domestic income, then NFIA subtracted from national income. But main formula is national income minus domestic income is equal to net factor income from abroad. Then here same thing already written. Domestic income is equal to national income minus, it is NFIA, suppose separately factor income from abroad and factor income paid to abroad given. So it is, in case of domestic income, it is different one. If separately factor income from abroad and factor income paid to abroad separately given, then when we calculate domestic income, then factor income received from abroad subtracted with national income and factor income paid to abroad added with national income. It is just reverse one. Okay, when we calculate national income, at that time factor income from abroad added and factor income to abroad subtracted with the domestic income, but it is just opposite one when we calculate domestic income. If separately factor income from abroad and factor income paid to abroad separately given, but if NFIA is given, when we calculate domestic income, then NFIA directly subtracted from national income. Clear? So in case of domestic income, you remember if separately factor income received from abroad and factor income paid to abroad it is given, then factor income received from abroad subtracted and factor income paid to abroad added. Just it is reverse one. It is reverse to the calculation of national income. The next one, NFIA is positive one when factor income earned from abroad is more than factor income paid to abroad. When we receive more than payment, then in this case NFIA is positive one. NFIA is negative one when receipt is less than payment, or payment is more than receipt. Payment to abroad is more than receipt from abroad. So NFIA is negative one when factor income earned from abroad is less than factor income paid to abroad. So in negative NFIA is also called net factor income to abroad. Remember, NFIA is 0. How much we received? Receipt equal to payment. Okay, NFIA is 0. Factor income received from abroad is equal to factor income paid to abroad. But in this case, you remember, when NFIA is 0, then domestic income equal to national income. Domestic income is equal to national income when NFIA is 0, because NFIA net factor income abroad by NFIA actually is the main factor to differentiate between national income and domestic income. We know that national income minus domestic income is equal to NFIA. So when NFIA is 0, then domestic income is equal to national income. Then other important points you remember, when national income greater than domestic income, then NFIA is positive one. When NFIA is positive one, national income greater than domestic income. And also remember, when NFIA is positive one, then receipt is more than payment. A factor income from abroad greater than factor income to abroad. One example it is also given. Domestic income rupees 100 crores, factor income from abroad rupees 20 crores, factor income paid to abroad rupees 10 crores. Calculate national income. So first calculate NFIA. NFIA is rupees 10 crores. It is factor income received from abroad minus factor income paid to abroad. Then calculate national income. So we know that NFIA is added with domestic income. So national income is rupees 110 crores. National income is 110 crores, but domestic income is 100 crores. So when NFIA is positive one, in which situation basically NFIA is positive one? Now when factor income received from abroad is more than factor income paid to abroad. Okay, when NFIA is positive one, then national income greater than domestic income. Just opposite, when domestic income greater than national income, in this case NFIA is negative one. When NFIA is negative one, now when receipt is less than payment, here it means payment greater than receipt. Factor income paid to abroad greater than factor income received from abroad. So in this case NFIA is negative one. When NFIA is negative one, then domestic income greater than national income. Example, you see, same domestic income rupees 100 crores, received from abroad, factor income received from abroad rupees 10 crores, paid to abroad rupees 20 crores. Then calculate national income. NFIA is minus rupees 10 crores, because NFIA is factor income received from abroad minus factor income paid to abroad. Okay, so here factor income NFIA is minus 10 crores. So in this case national income, it is domestic income plus NFIA. So national income is rupees 90 crores, but domestic income is rupees 100 crores. So when NFIA is negative one, then domestic income is greater than national income. When NFIA is negative one, now when factor income paid to abroad is greater than factor income received from abroad, when payment is more than receipt. Next, when net factor income to abroad is given, when net factor income from abroad, net factor income from abroad, then it added with domestic income to calculate national income. But when in numericals, when net factor income to abroad is given, then it must be subtracted from domestic income to obtain national income. When we calculate national income, net factor income to abroad subtracted from domestic income. It's just opposite of NFIA. When NFIA is given, then it is added with domestic income to calculate national income. But net factor income to abroad given, then it must be subtracted from domestic income to obtain national income. Just to remember. So national income is equal to domestic income minus net factor income to abroad. So to abroad, from abroad added, to abroad subtracted. In case of numerical, it is very important. Then other points, if NFI is not given, but separately factor income from abroad and factor income paid to abroad, separately given. Directly NFI is not given, but separately factor income from abroad and factor income paid to abroad given. Then when we calculate national income, then factor income from abroad added with domestic income and factor income to abroad subtracted from the domestic income. Okay, or in the numericals, if NFIA is given and factor income from abroad given, then only you consider NFIA, because factor income received from abroad and factor income paid to abroad is the part of NFIA. If NFIA is given, then you do not consider received from abroad and payment to abroad. So only you consider NFIA. But separately given from abroad and to abroad, then from abroad added with domestic income, to abroad subtracted from the domestic income. Same thing. I have written here. Symbols also how to read. Gdpmp, gross domestic product at market price. Gnpmp, gross national product at market price. Ndpfc, it is the domestic income, the symbol, you know, net domestic product at factor cost. Nnpfc, national income, it is net national product at factor cost. So two things, very important one. Domestic income symbol is Ndpfc, net domestic product at factor cost. It is the net money value of all final goods and services produced within the domestic territory of the country. Okay, in this case we consider both the contribution residents and non-residents. And in case of national income, Nnpfc, it is the net money value of all final goods and services produced by the residents within country and from abroad during an accounting year. So Ndpfc, it is the symbol of domestic income. Nnpfc, it is the symbol of national income. Clear? Then other things, very easy one, gross to net depreciation subtracted. Gross to net depreciation subtracted, same thing I have written. And net to gross depreciation added. An example also given. Net to gross depreciation added. Alternate name of depreciation is consumption of fixed capital. Clear? So gross to net depreciation subtracted and net to gross depreciation added. Then similarly Gdpmp, it is market price. Suppose calculate Gdpfc, FC given, calculate MP. So FC to MP, conversion of FC to MP, net indirect taxes added or indirect taxes added, subsidies subtracted, because net NIT is the difference between indirect taxes and subsidies. So calculate Gdpmp, Gdpfc given, NIT given, calculate Gdpmp, NIT added with Gdpfc, or indirect taxes added, subsidies subtracted with Gdpfc to calculate Gdpmp. Similarly, Gdpfc is equal to calculate Gdpfc, Gdpmp given. So MP to FC. In this case, MP to FC. MP to FC, NIT subtracted, or indirect taxes subtracted, subsidies added. So similarly, Ndpmp, it is Gdpmp minus depreciation. Domestic income, you see, Ndpfc. Calculate. Suppose Gdpmp given, calculate Ndpfc. So Gdpmp given, G to N, gross to net, depreciation subtracted. Then Gdpmp, market price given. Okay, market price convert to factor cost. It means NIT subtracted or IT subtracted, subsidies added. Same thing I have written. It is Gdpmp minus depreciation or CFC minus NIT. So again, if Gdpmp given, then from Gdpmp we calculate Ndpfc. So it means how to calculate. So gross to net depreciation subtracted, MP to FC, NIT subtracted, or indirect taxes subtracted, subsidies added. Okay. Similarly, Gnpmp, it is Gdpmp national, domestic to national, Gdpmp given. Gdpmp given within you see GDP middle D, domestic territory. Gdpmp given, calculate Gnpmp, domestic to national, NFIA added, net factor income from abroad added, but in numerical, if net factor income to abroad given, it must be subtracted. Domestic to national, NFIA added. Okay, or net factor income to abroad given, it must be subtracted, or just opposite. When I mean national to domestic, NFIA subtracted from, suppose here calculate Gdpmp, Gnpmp given. How to calculate Gdpmp? Now Gnpmp minus NFIA. Domestic to national to domestic, reverse one, domestic to national. But here in my example it's given, it means domestic to national. We calculate Gnpmp. Gdpmp it is given. We calculate Gnpmp. So domestic to national, Nfia added, but national to domestic, Nfia subtracted. Or similarly, domestic to national, net factor income to abroad subtracted, but national to domestic, net factor income to abroad added. Just opposite. Here same thing, Gnpfc is equal to Gnpmp minus NIT, or Gnpmp minus IT plus subsidies, Gnpmp, Gnpmp minus depreciation. So here national income you see, Gnpmp, it is Gnpmp given, calculate Gnpfc. Gnpmp given, calculate Gnpfc. So G to N depreciation subtracted, then MP to FC, NIT subtracted, or IT indirect taxes subtracted, subsidies added. Okay. So other things you remember, domestic to national, Nfia added, and reverse one, national to domestic, Nfia subtracted. Similarly, domestic to national, net factor income to abroad subtracted, from abroad to abroad, from abroad domestic to national added, to abroad domestic to national subtracted. So just very important one. You see, net factor income from abroad given and net factor income to abroad given. It is net factor income from abroad given, domestic to national added, Nfia added, and reverse one, national to domestic, Nfia subtracted. But if net factor income to abroad given, domestic to national, net factor income to abroad subtracted, but national to domestic, net factor income to abroad added. Okay, thank you.